Good afternoon. My name is Ala McCoy. I'm Director of Startup Support at the University of Maryland's Ventures. And I would like to extend a warm welcome to all of you who joined us today for the next installment of the Startup Fundamentals Workshop Series, both live webinar audience and those watching a recorded version on our Startup UMD YouTube channel. This workshop series is offered by Ventures at the University of Maryland. Everyone attending the live session, please feel free to submit questions using the Q&A function. It's probably at the bottom of your screen. If you see a question someone else submitted that you like or similar to yours, you can upvote it and it will be answered first. This session is recorded, will be posted on our Startup UMD YouTube channel, and so therefore you can submit your question anonymously if you would like. So in today's session, we will cover the complex but very important issue of taxation as related to startups. We were just talking with Sam how very few people understand it, but yet how important it is. So I'm pleased to introduce today's speaker, Samuel Handwerger, CPA, Master's in Taxation, and lecturer at the Robert H. Smith School of Business at the University of Maryland. Thank you, Sam. I'll let you talk a little bit more about your background. And the microphone is yours. Thank you so much for your time and expertise.
Thank you for having me on. I appreciate getting the opportunity to talk to entrepreneurs. They always excite me because they're full of positive energy, and it's like contagious. Allie, if you would do a favor and check the chat box every once in a while, if you see a question that should be answered in turn while I'm speaking, just interrupt me, and I'll be glad to do that.
Yeah, I'll do that. Thank you. Yeah, so please feel free to submit questions as they come to your mind.
Great. Okay, I will share my screen in just a second, but welcome all attendees here. Thank you very much. We are going to embark upon just a broad overview of taxation, but the things that entrepreneurs getting ready to start or already starting their businesses need to know. And I, just as a way of introduction, I've been practicing as a CPA for about 35 years. As Alice said, I have a master's in taxation. And so that's been mostly my area of delving into the CPA world. All right, let's get started because a lot to accomplish, a lot to go over, and I want to make sure we get through as much of it as possible, and away we go. All right, so what you see here is we're going to start talking about startup tax issues, startup businesses, and how they relate to you all. We are going to first talk about what's the right business entity to choose for if you're a startup company. There are several choices out there, and you want to make the right choice. As a way of introduction, before getting involved in the nitty-gritty of the choices that are out there, I will tell you the conclusion now, and then you can follow along and see why it becomes the conclusion. The conclusion is that you're probably going to start as a limited liability company in whichever state you are headquartered doing most of your business. And then you'll have the opportunity, should you need to, for tax purposes, to elect to be recognized as a corporation. If you deem that to be the better way to go, you also have the opportunity to elect to be taxed as a S corporation. But your limited liability company, for all intents and purposes, will be a limited liability company the whole time, regardless of your tax status. That's a lot of information, and I hope to break that down further. So if you didn't follow all that, hold on to your seats. The upshot of this decision to be a limited liability company, or, and I'll put in parentheses, a corporation, is that you want to protect yourself as an owner from outside liability, from outside creditors, from outside people who might feel that you have wronged them in your business and want to file a suit. The only thing you want to have at risk is what's ever in the business. And that's what these entities do. They allow you to limit your liability to whatever assets, whatever money, whatever equipment you've put into the business. That's the only thing you could really lose. Having said that, there's a caveat, which is for professional services like accountants and doctors and lawyers and the dentists. There's different rules in the states which don't limit that liability that way. But you still, even if you are a professional that doesn't have that legal liability protection because you're a professional and you're liable for your professional acts or wrongdoings, you still get some protection in the event that the person filing suit or chasing you down is not chasing you because of your professional work. Maybe it's because of a contract that you got involved in, or they don't feel you fulfilled paying them the right amount as a supplier. You still get liability protection there. And therefore, regardless of state laws that might undo most of the liability for professional people, it's still the best way to go. So upshot, you're going to want to be either a corporation or a limited liability company, most likely for tax purposes, starting as an LLC. The only reason not to start as an LLC is if you need to raise capital by selling shares of stock. Then you'll definitely have to default to a corporation, which is allowed to sell shares of stock. If you're a limited liability company, you can still raise capital, but not as shares of stock. You raise capital by people who become members of the LLC, or you might call them investors, partial part owners of the LLC. All right, so that's the introduction. Let's go into the nitty gritty. You've got, as choices of startup companies, you got sole proprietorship. That's not going to happen because you don't have any liability protection. It's all taxed on your individual return. I don't recommend it. It used to be, I would say, if you don't think the business is going to for sure go anywhere, you're just trying something, why go to the bother of setting up an LLC or a corporation just for liability protection? If you're just dabbling and you're not going to hurt anybody, hey, then stay as a sole proprietorship for a while until it takes off. Well, it doesn't take much to hurt anybody in this litigious society. So I've gotten off that bandwagon, and I just don't recommend even starting here. Partnerships are really just two or more sole proprietorships put together. There is no liability protection here. They are taxed as pass-through entities, meaning you pay tax as you make money in the partnership, your share of that partnership profit. There are still some partnerships out there, but they're not mine, and they're not my clients. Again, with no liability protection, I'm not recommending it. So now we get to corporations, which does have the liability protection. For tax purposes, now we can concentrate on the tax part of it. Corporations, which are classified as C corporations, are subject to 2 levels of tax. Now, that might sound terrible, but it's not as bad as it used to be. C corporations are taxed entities, and that translates into the following. That translates into a 21% tax rate based on the amount of money that they make as they make the money. And then if they pay dividends to the shareholders, to the owners, there's a second level of tax on the dividends paid. So that's where the second level of tax comes in, and that's why we say they're double taxed. However, even at that combined rate of 21% and then the dividend tax to the individuals, which is at maximum around 20% or plus, a little bit more sometimes, depending on the tax bracket of the individual, it still comes out to just about the same rate as the highest individual rate. The combined of the 2 taxes, the double tax, still gets no further than the highest, this is as combined rate of the individuals. Say it one more time. In fact, let's do it this way. The regular highest rate, the highest rate for an individual is 37%. The combined rate of the corporate rate of 21% and the 20% tax to the individual as a dividend doesn't get any greater, or not much greater, than the 37% that an individual would pay if they recognized all of the taxes of the corporation on their own individual return right from the get-go. So it's not a double taxation that says, well, never do business as a corporation, a C corporation, that is. It's at the end of the day, it's not much different than being an individual and earning the same amount of profit. Now, why is this 20% here? And that's because dividends have a special tax rate. There's a preferred tax rate, 20% as opposed to the individual highest rate of 37%. Holy cow. If I've lost you, it's no wonder. Taxes, income tax is fairly complicated. My guess is I have some STEM individuals out there in the audience. I bet I do. And if you haven't heard this quote from one of your gurus, Albert Einstein, it is known that he said this, publicly been corroborated, that he said, the income tax is the hardest thing to understand in the world. So if it came from him, I'm just the messenger. All right. Again, C corporations are double taxed. Most likely, you're not going to do this as a startup because these are really relegated to where you're offering stock to the public and you're going to be listed on an exchange at some point. You're trying to go to be a public company. You're trying to raise millions and millions of dollars. So you probably aren't starting that way. S corporations is a form of a regular corporation, like a C corporation, where there's limited liability protection. But as the word or the letter S seems to signify, it seems to be as if, and it is, standing for small corporations. So they're perfect for your startup in many cases because they're not double taxed. They're easier to take care of from a tax perspective. And the profits just pass through to you, the owners, and you pay the tax at your individual level. Once again, small corporations or S corporations are corporations under state law. They have elected to be taxed as a S corporation, meaning they've elected to get rid of the double taxation that C corporations have. And all the profits pass through to the owners. They pay the tax. Wonderful, one level tax. There is one thing that I want to just zero in on now, which is really important. I'm going to change colors here for a reason. With these pass-through entities, that's what we're going to call these, pass-through entities, meaning there's no tax at the entity level. The tax goes direct on the income, the tax goes directly to the individual. They report the profit on their individual return. The S corporation doesn't pay any tax on that profit. It's just passed through to the owners. They pay the tax on their individual return. But here's the big thing. Many startups have the need to, the requirement, almost like a requirement, almost like an academic requirement, to experience losses in their first year or two, perhaps a little bit more, depending on the nature of the startup. It's just the way things are. Amazon, I don't know how many years it was, but it was almost like a record breaker number of years of losses before they turned a profit. It's part of the world we live in, the tech society, creating new industries basically overnight. So those losses, when you have a pass-through entity, also, like the profits, they also pass through. So the result is you could be doing the following. You could be working to make a living. You could be spending another 10, 20, 30 hours a week besides your full-time job, starting your business. And for the first year or two, you're generating a loss because that's the nature of that business model. And that loss passes through to your individual return and you get to use it against your other income. So to illustrate, you might have on your individual tax return, you might have your salary, call that 75K. And then you might have your S corporation pass through. And because it lost money in the first year or two, let's just do one illustration. Let's say it lost 25. Because of that, you're now only going to be taxed on 50K on your individual return. So you get the benefit, a tax benefit. You lower your taxes, you lower your income tax liability because of the pass-through of this loss from the S corporation, from the pass-through entity. So the beauty of an S corporation is not only getting rid of the double taxation, but passing through the loss to you, the individual owner, or other owners as well. So it passes through to all the owners in proportion to their stock ownership. That's not the same with a C corporation. If a C corporation loses money, it just carries forward the losses until it has profits. If it never has profits, nobody gets the benefit of it really, although there are some exceptions to that. But the result is you're just not getting the tax benefit of the losses in the first year or two. So one more time is that the losses pass through, and that can be a tax benefit to people who are involved in a startup business. Coming to limited liability companies, they are the same thing in terms of taxation as the S corporation. So we already know how this works. It's a pass-through entity. It makes money or loses money, and it passes through that profit or loss to the individual. So the same advantage, same tax advantage that we have with the S corporation exists with the pass-through LLC, limited liability company. You'll pay tax on profits currently, but you also get the advantage of, if there are any losses, you get to use that to offset other personal income that you might have. These are terrific advantages from a tax perspective, which is why I'm going to say that I would go probably with the LLC first. And the LLC first concept is also illustrated on this slide. So I'm saying LLC would be your first choice, most likely. Exceptions, I'll give you one of the major exceptions in a minute. But then what happens is, if in the event that there's a reason to be a S corporation, the LLC has, from a tax perspective, the ability to make the choice. Oh, I choose to be taxed as a S corporation. You tell the IRS, and you'll be recognized for tax purposes only as an S corporation. Great, you got that, if that's what you want. And you're still a pass-through entity, but you haven't changed your charter. You're still under state law and LLC. So it's no big deal. It's one piece of paper to the IRS, and you got all the advantages of an S corporation if you need an S corporation. Let's just break down the partnership level one more time to one deeper dive. Not the partnership, I meant the LLC. LLCs by default are taxed as if they're partnerships, but I don't want to use that term. Let's just call them pass-through entities. Now, when the LLC is taxed as a pass-through entity by itself, then you would want to be an LLC if you are also concerned about losses, because they'll pass through to you. But you're going to want to be an LLC and not make the election to be a S corporation if you're in real estate. So if you're doing real estate work as your startup, you're going to be an LLC, and you'll probably stay there the rest of your life. In the event that you're not just doing real estate, then the S corporation choice, this is called check the box. That's what it's known as, check the box, to be recognized as an S corporation. Then you might make the choice to be an S corporation if you have a lot of compensation, meaning you have a high salary because you're making money through your own efforts. Perhaps you're a consultant. Perhaps you're you could be a doctor or a computer engineer. In that case, the S corporation has some advantage because it can have a little bit lower payroll tax, or perhaps I might say a substantial lower amount of payroll tax. So you could save on payroll taxes by being a S corporation, making that election. I'm not going to go into the details of that right now because that's a whole hour or 2-hour seminar. We don't have that kind of time. But I just want to point out to you that when you start your business and you become the LLC based on my recommendation, and you're not in the business of real estate, there may come a time when you are paying yourself a salary that is becoming substantial. And at that point, you may want to choose to be taxed as a S corporation and get a little bit of a break, possibly, for your payroll taxes. More on that when you go to your CPA and see exactly how your business is doing. So that's going to depend on what kind of profits you're showing and just exactly how your business is running. All right, so just a summarization here, basically. There's not much difference if you're a C corporation with the double tax versus the individual tax rate, so I wouldn't worry about that. The qualified business income tax deduction here is not anything that you got to get worried about. It's just basically saying that if you're a pass-through entity, your tax rate at even a double tax, compared to the double tax level of the C corporation, your tax rate even at the individual level will be better than the C corporation. Let's just illustrate that 1 second, because I think it's an important point just for you to know. You don't need to know the details of the QBID. You just need to know that what it does is it brings your rate down from your profits of your pass-through entity. It brings your tax rate down to something a little bit below 29%. A little bit below 29%. So let's do it this way, a little bit below 29% compared to the potential 37 or 38% at the C corporation level. Bottom line point, all you got to know is to make the choice not to be a C corporation, to make the choice to be an LLC, pass-through, or S corporation, you basically can't go wrong from a tax perspective. All right, we are going to move on to tax deductions. The point of tax deductions is we got to take a quick look at the tax formula. Tax formula says we report all our income. So let's dream on a little bit. And then you're going to pay tax on the net income. Our system of taxation is a net system. So you reduce that number by your allowed deductions. So we'll put here AALEW, allowed deductions, as by the Internal Revenue Code. And let's just say that's 50. So you'll be taxed at the tax rates on your net and ET. And that's basically how the tax formula works. And therefore, you probably already know this. Having this is not bad as long as it doesn't eat too much into your profits and they're necessary. I mean, you don't want to spend all your profits. But if you're spending your profits and it falls into this category, you can see by the formula how important that is. Therefore, if you have an expenditure for, let's say, taking somebody out to lunch for a business meeting, and you know that, hey, that can be a deduction in this category right there, you're lowering your tax at the same time enhancing your business, enhancing your networks, making a good showing with either existing clients or potential clients or whoever you're meeting with where you're promoting your business. So let's see what they are. They come in some varieties. First, there's what's known as startup business expenses. That basically means before you start business. These are things that you spend maybe money with a lawyer to get set up. You maybe spend money with a CPA, all before you're actually doing business. You may have infrastructure that you're setting up, but all before you've opened up your business to the public. So that's prior to startup, pre-startup expenditures. You don't get to deduct a whole lot of that at the time it happens, but once you start, you can start taking those deductions at that time. It's a little more complicated than that, but you're not going to lose these deductions. You'll get them, but you just really can't take deductions before you've opened up your shop. So word to the wise, try to open up at least as much as possible as soon as you can, so that you don't have to worry too much about these complicated rules of startup expenditures. Again, you don't lose them, you just have to follow certain rules. And you'll want to give the startup, pre-startup expenses to your CPA in a category that says these were before I started business, these are the ones afterwards, so the CPA can work the magic of complying with the tax code. Here's one that follows in that line of, hey, if we can get this into a deduction, we're going to lower our taxes. And at the same time, it's an expenditure we couldn't avoid because it's a home office. You might hear a lot about that, and that's good because home office expense deduction is like a great thing. Think of it this way. Think of, I'm here in a setting that's like my home office, but I don't run my own business. Well, let's just say I don't run my own business. Okay. I don't run my own business. So this is just a personal expenditure. However, if I'm running my own business, now part of it could be an expenditure, a deduction for my business profits, my business income, and I get to lower my taxes. So when you have this, you are able to convert what most people can't use to reduce their taxes. You basically have the opportunity to convert some of that to a deduction for purposes of lowering your taxes. That's great. And that's why it's powerful. Question?
Yes, we have two questions. So one is a write-off considered a deduction? Does the business owner classify these expenses?
Yeah, write-off is another terminology for deduction. Yes, if you hear a business owner saying, well, you can write that off, that's what it means. Writing off, like WRITE, you're writing it off on your tax return, reducing your taxable income. Yes. Next question.
And the next question is an EIN required for a single member LLC?
That's a great question, actually. It's a little bit more complex than I was trying to avoid that one, but I'll answer it straightforward. A single member LLC is taxed on your individual return and therefore does not require its own taxpayer ID unless it has payroll. If it has payroll, then you have to get, meaning not just pay to you, but paying to other people, then you have to get a taxpayer identification number, otherwise known as a TIN. But if you're single member LLC, nobody's working for you, you don't need it, it's you. Single member LLCs, for the person who asked the question, are ignored. This is a tough one to get through to MBA. I hope I don't have too many MBAs too many MBA students. It's a tough one to get across because it's a little weird, but single member LLCs are ignored for tax purposes. It's as if they didn't exist. So single member LLC is a sole proprietorship only for tax. You've protected yourself from a liability standpoint, but for a tax perspective, you are a sole proprietorship. I'm smiling because
Thank you.
I'm smiling because I realize how complex this is to someone who may not have been exposed to this before, and I'm smiling because it's better than crying.
Yes, thank you.
Okay. Now, the home office deduction is tricky to get on a business return today because there's some limitations. But the easiest way to do it is just have your business reimburse you for the expenditures that you are incurring at your home office. If your home office is, and it really needs to be your main place of business, so it works mostly for startups where they don't have a rental space that they're using and they're spending a lot of time at the home or the rental home. It can be a rental home, it can be an apartment, it can be an owned property as well. And the best way to do it is just have the business reimburse for the expenses of using the space at home. So have reimburse. So what you would want to do is figure out how much square feet are involved, what's the going rental rate, what hours of the day or the week were used for business, and just pay that amount based on how you use that space for the business, how you dedicate it. I wouldn't do a rent. I would just do a reimbursement based on same concept as rent. And the way the rent would be calculated would be based on square footage compared to the area that you live in. You would compare it to what other rents go for by square foot, and you would add in supplies, utility costs, things like that. And then you could add up the number of hours, let's say, that you use the office during the month for the business, so the business then sends a payment to you, reimbursing you for the rent or the mortgage or your expenses to keep the house going. It pays that reimbursement back to you again based on square footage times time used. So you would develop just a very simple hourly rate. You could compare it to going to, let's say, one of those work environments where you pay an hourly rate or a daily rate to be there, and you would do the same thing with your business to yourself, reimburse yourself from the business. That's the easiest way and most straightforward, the way that will probably be less complicated on an IRS audit if there ever was one. Okay. You also get to write off, I'll use that expression now, travel and entertainment deductions. However, let's put a little bit of an X there. This doesn't come back as a deduction until 2026. It was been put on hold based on the 2017 Tax Act, but it'll be coming back. But in the meantime, the travel costs are deductible. So if you need to go for a day trip or overnight for business purposes, primarily for business purpose, and that's easy to get into that bucket of being it's primary for business purposes. Most travel can be put into that niche that qualify that way, and so the cost of travel can be deductible, can be written off on your taxes. You do want to have good documentation on all your expenditures, particularly for the travel part, and it's really cool. So you may be saying, well, I want to travel to New York City to meet with some people. I don't have any business there, but I want to meet with some people. Maybe there'll be business, maybe there won't be business. That's still a travel expense for the business. It's still promoting the business. You don't have to be, by the way, for just a general rule, you don't have to be successful with the expense that you incur. The expense that you can incur for your business doesn't have to yield to income. It has to be hoped that it'll help income. It has to be hoped that it'll promote your business, but it doesn't have to be. So these expenditures, these expenses, these write-offs, these deductions, they just merely have to be able to be demonstrated as to being ordinary, that businesses would incur, that your business would incur, ordinary and necessary. That's what the tax code says. And the good news about this language, this ambiguous language, is it's been subject to the tax court's PPJ rule, which is it's the business owner's judgment. So it's the business owner's judgment is generally recognized as if the business owner said the business should pay for this, it's a good idea. Maybe it'll work out, maybe it won't. It'll most likely be considered a legitimate write-off. So one more time on that, just to make sure. You just have to be able to show the business purpose. It doesn't have to yield income, but there had to be a purpose. When I first started working, quick little story, when I first started working at Ernst years ago in their tax department, one of the first things I did is I write memos for clients' internal files explaining expenses that they had, what was the business purpose, so that it wasn't lost years later as to why did we spend that money? Well, I don't remember. Why did we do that? So we would have a memo to the files that the owners would keep explaining what the business purpose of that expense was. And obviously it wasn't clearly a business expense. It was the ones that were a little bit on the peripheral, like some travel or something of that, or in those days, entertainment expenses, which was allowed. And so we'd be explaining what the business purpose was. Education and training mostly is deductible. There are some limitations, but most of the time, if you can just say, hey, this training, this education is related to what I'm doing in my business, it's related to the business, then it's going to follow the same business owner's judgment rule and be a write-off. Payroll, obviously, or fairly obviously, if you have to hire somebody to help you in your business, that's going to be deductible in full. You do have to comply with the employment tax requirements, which we're going to get into. And you may find that you have benefits that you need to pay for the employees. That's all deductible as well. So payroll is pretty straightforward, as is rent. I'm not listing all the business expenses out there. Rent's easy, deductible. Supplies is easy, as you can probably imagine. My list heretofore was one of those things that are a little bit less obvious. And just so I don't forget, in case I don't have a slide for it, let's just do it now. Another one that's out there is travel. And I don't mean overnight travel or the travel like the slide we had before. I'm going to call it automobile. If you are working from home in your startup business and you are getting into your car to visit a client or visit a potential place to do business or visit a landlord, as maybe you're thinking of renting space there, or you're going to the library to do research for your business. Well, we don't do that too much today anymore, but you get the idea. You're using your car, and the primary reason for getting in that car at that particular time was it's business related. You're able to create the relationship of the trip with the car. It has a business purpose. In that case, your mileage that you put on the car per mile is deductible, is a write-off. There are other ways to do it, but the simplest, least complicated way to take deductions for your auto is the mileage rate. The mileage rate changes based on the cost of gasoline and insurance, and the IRS puts out a certain rate per mile. I don't know what it is now, but I think it might be close to 70 cents per mile because the cost of gasoline went up. And that means if you drive 500 miles a year, you're going to get roughly like a $200 deduction off your income. And that's not something to be missed. Now, maybe you're driving more like 25,000 miles a year for your business because you're traveling to Pennsylvania, you're traveling to Virginia, you're traveling for purposes of business. All that gets deductible at the 70 cents or whatever the rate is. Just check the irs.gov and you can see the current rate. The way to handle this, to make sure you can substantiate this deduction, and the way you're going to do the deduction is as follows. you're going to keep a log of your business miles. You can do that. You can do that very simply. You don't have to do it every day. Keep a sample. The IRS will recognize a sample log of what your year would have looked like. So you keep a sample of 2 months, let's say, and you multiply it times 6. If the 2 months are typical of most months of the year, that's a great sample. Every day in that 2-month period, you keep a log of the business miles you've driven, multiply it by 6. That gives you your business miles for the years. And then, just like we did with the home office, have your business reimburse you the mileage rate. In order to get the deduction, have the business reimburse you for the amount of miles you drove with your car. There's another way to do this. I don't recommend it. Right now you're trying to grow your business. To get involved in another method of taking the automobile deduction is maybe give you a little bit of a higher deduction, maybe, but the headaches you'll go through to get there and the time you'll spend, in my opinion, is just not worth it. Plus, when an audit by the IRS, you'll go through greater scrutiny. So this is the easiest way. Just keep a business log of the number of miles. As I said, these samples works fine. Every month, tell the business how many miles you drove for business purposes. The business pays you back by the mileage rate that the IRS gives out. Simple way to do it. Back to payroll expenses. Let's go through this rather quickly, because in addition to the actual gross salary, which is fully deductible or fully able to be written off of people that you pay, then you also will probably have payroll benefits to attract good people. Almost all of those are deductible. You do have to comply with insurance laws for health insurance. You will have to comply with rules for 401k plans. You're going to probably need an outsourcing person who is expert in the health insurance area to set up a group plan for your employees. And you're going to need an expert when it comes to your 401k plan to help you set that up, because it's rather complicated. So those are 2 outsourcing people that you're going to need. There's your 401k, which most likely you'll do in order to, as I said, to attract good people. It's an employee retirement program. The cost to you to do so is deductible. It's a write-off. Okay, the bad news. I like deductions the best. All right, the bad news when it comes to payroll, so we're still talking about payroll, is that you probably know this because you've been working somewhere, but for every $1 you pay an employee, it's going to cost you $1 plus. It's going to cost you $1 plus whatever this number comes out to be. These are the Social Security and Medicare combined amount. And today the rate for an employer is 7.65%. That's matched by the employee. So this is the employer. This is the employee. We'll emphasize the 2 E's. So the total rate's 15.1, 15.1, 15.3. Total rate's 15.3. But the employer only pays half and the employee pays the other half. However, now you've added to the cost of the $1, 7.65% of that $1. Then you're going to add to that the percentage of other payroll taxes like unemployment insurance, workers' compensation. That could add up to another, let's call it 5% for a startup business. So it'll be another 5%. Then you're going to have your 401k costs. That could be another 5%. Before you know it, the cost of every $1 payroll you pay could turn out to be between 15 and 20%. So you have to keep that in perspective when you go to hire somebody, that it's not just the salary, it's the salary plus probably a good 20%. And you're going to want to have a payroll service to help you with all this, because you have to deduct all this you have to deduct this from an employee's pay, meaning you have to withhold it from the employee's pay. You got to withhold their income tax from the employee's pay. You got to comply with the state unemployment law, workers' compensation law. So the best place to go is a service that's, again, outsourcing for payroll. They come in all shapes and forms. You got big ones like Paychex and ADP. You got some small ones out there, some neighborhood ones. I will, let me, I think this is one of the places where I want to just stop the share for a minute. I want to just give a word of caution. If you do wind up needing to pay employees, if you're at that stage of the game, when you choose a payroll service for all this compliance work with the withholding taxes and the Social Security, that's the FICA, please use a reputable place. There's been a lot of fraud out there where the services don't withhold the taxes, or they don't pay the taxes into the IRS the way they're supposed to. They don't pay them into the state. And you remain liable on all of that, even if they have defrauded you. You're still liable to pay it again. So you might say to the government, well, hey, somebody stole from me. Well, too bad. You still have to pay it. And it's a nightmare. So use a reputable service and don't get into trouble. Now, I don't get any commissions, but ADP is certainly good and Paycheck's good. And yeah, they're big and you may be a small fish in the big pond with them to start off, but make a good connection, make yourself friendly and easy to use, and you will find somebody good there to help. All right, back to screen sharing. Okay. All right, so we are back to, where are we here? Oh, there we are. Okay, so we're back to unemployment taxes or employment taxes. Social Security tax, we just went through the two rates, the two halves of it, the 7.65 for the employer side and the employee side. The Social Security tax of the FICA that we went through is 6.2. The Medicare side is going to turn out to be 1.45, again, ending up to that 7.65, just to show you the math. The Social Security tax, the good news about that is it does stop at a certain point. Unfortunately, as you can see from this chart, where the Social Security, the 6.2% stops, has been rising steadily and dramatically every year because of the cost of paying out Social Security benefits to retirees. This number right now is the first $160,200 of payroll is still subject to the 6.2%. And next year it's going to go up probably dramatically again. And so that's part of the deal. Once you pass this, once you pass that level, you don't have the 6.2% anymore. So it's like, hey, wow. You have the 6.2% up to the 160, but not for dollars beyond that. So it's not a freebie, but it certainly is a relief for the dollars you make above that. Make a couple $100,000 a year, you got a couple hundred that are over the 160 limit. Medicare tax is that 1.45 at the employer level plus the employee level 1.45, and so that will yield a 2.9% combined rate between the employer and employee, and that does not have an end. That just total all your salary. So you go up to $10 million, it's still subject to the 1.45% for the employer, and so forth with the employee. Now, self-employment tax. If you follow the idea of this pass-through entity, you're going to have an issue, which is what is subject to the self-employment tax. Let's first explain what that is, and then we'll get into the issue a little bit. Self-employment tax is, let's say you're working for yourself, but you're not paying yourself a salary. So the question is, how much FICA tax do you have? You are your own employer and you're your own employee. Why? Because you're working for your LLC. So when you are working for your LLC, all of your profits, all your LLC profits are arguably subject to the self-employment tax, which turns out to be 15.3%. Ouch. Yeah, ouch. But it makes sense from a theory standpoint because you're the employer and the employee, and that's what the rate should be. So you're going to have an issue when you get to your profits from the LLC as to how much of it is subject to the combined rate for self-employment tax and what part of the profits are not part of that. And that's not 100% clear. So here's where, and I got to watch the time a little bit on this. We are doing okay, but I want to watch the time. I just want to point out that here is at this point, depending on the amount of profits you're making, the type of business you have, this is where the LLC might become a good point where you would make the election to be taxed as a S corporation. You make that election. And at that, the reason for that is you can control what's going to be subject to the 15.3% when you make that election, because you can control the salary of the S corporation to yourself. So we'll call it owner's salary. Now you can actually declare a salary where the LLC doesn't have this advantage. When you're an S corporation, you can control the salary to yourself and thus limit the exposure to the 15.3% rate, the combined rate for employer-employee. Remember, you are the employer. Just as a quick illustration, President Biden did this on his tax return, at least one of the ones that is in the public domain that I looked at, where he had $10 million of profit. He elected to be an S corporation. The salary he paid out of that, he declared out of that 10 million, he's declared a salary of 100K. So he paid the Social Security taxes on that, but on the rest of it, he escaped no payroll tax on the rest of it. That's the advantage of an S corporation. It gives you the ability to control your fate when it comes to the combined rates of that Social Security times 2 and Medicare times 2.
Sam, we have a few questions.
Certainly, I would imagine so. Go ahead.
Yes. So first question, is it better to outsource as 1099?
Outsource, set one more time.
Is it better to outsource as 1099? My guess,
okay. I got it. We're gonna make sure we don't miss that topic. What's the other question? I'm gonna come to that in a second.
Sure. And the other one is, can you give some examples of reputable service?
For payroll taxes?
My guess, yes.
All right. So again, I mentioned ADP. That's a good one. ADP. Paychecks is a good one. If they are large, if you find that you're not happy with because they're so large, then you could contact me. You'll give them my email address, and I can give you a really good referral of a really reputable place that's been around 35 years, as long as I've been around in business. And you won't have any worries about losing your money to fraud. So we'll leave it at that. Any other questions out there besides that?
No, these are the only two outstanding questions.
Okay, let's stay where we were when we were talking about this S corporation and the amount of salary. And then the question came up, what about not declaring somebody as an employee? So let me find that. Oh, I'm going to just race forward and find that spot for that. Okay, so hold on. Here we go. Here it is. I was real close to that question. That's good. Employee versus independent contractor. This is a W-2 person, someone you put on the payroll. And this is somebody you could say outsource the way you said, or a 1099 independent contractor. This is a really cool way of doing business. Say you looked at all the requirements here. You got to withhold taxes. You got to pay ADP or paychecks. You got to pay Social Security. You got to pay health benefits. You got to pay a 401k. Man, who wants it? Who needs it? So you might say, well, let's just hire people as independent contractors. And what happens if you hire somebody and you call them an independent contractor, and even if you give them a contract that says you're an independent contractor, all that W-2 stuff, all that withholding tax, it's not there. You just pay them an hourly rate, an agreed upon contract rate, and they have to take care of it all themselves. Sounds wonderful, right? Except if something is too good to be true, it usually isn't, and that's the case here. The IRS is on a vendetta, and they've been on this vendetta for 30 or 40, 50 years, and that is they can't stand when people try to avoid all those taxes that go along with the W-2 part by claiming somebody to be an independent contractor. They feel that there's a couple reasons they can't stand it. One is some people that you pay as independent contractors don't pay their taxes because they don't know to do that. They fall behind, and then the IRS can't collect the money. So that's a problem. But the IRS feels that they lose track of these 1099 people, and they really don't like it. So the question is, who is an independent contractor and who is a W-2? And that question has never really easily been answered either over a 50, 60-year period of time. So I don't know. I mean, in 1970s, they tried to rule what's the definition and come up with some precise definitions, but that fell through. It never got passed. So we're here in 2023, and it still boils down to facts and circumstances. Generally speaking, if you control the hours, the place, the type, the style of the work, if you control the style of the work or how it's going to be done, the more you control the person that you're hiring, quote unquote, the more likely the IRS is going to say, and the tax court would say, it's a W-2. Your 1099, your independent contractors, in order to get to that point where you can avoid all this payroll tax garbage, is they've got to be truly independent. Like me, I'm independent. If I do accounting work for you, I'm not on your staff. You hire me, I do it on my own time. I do it as I please. I do it my style, at my place. And I don't work for you full time. I don't look like or smell like or walk like an employee. And that's what you got to be concerned about. It's not an easy snap judgment of who is and who isn't. Sometimes, like with a CPA, it is hiring a consultant who's just going to come in for a couple hours or just for one project. That's easy to see. Be careful. Don't just run to the 1099 choice in order to get away from all that. I caution you, again, the audit rates are really extremely low at the IRS today, but playing the audit rate game is dangerous because they got 3 years to audit you after you file your returns. If they get caught up, if they get their act together, they could, and they do run after these independent contractor issues as much as they can. So it's just not worth it. If you have a lot of people you're doing this with, I give you caution. Or just make sure that you're handling them like an independent contractor. And since it's facts and circumstances, you're going to probably want to have a CPA look over your shoulder and say, yeah, that'll work. That's what you would probably want to do. Sorry to be vague, but it's caution needs to be said. All right, we missed a couple slides. I think the Medicare tax, if your income goes high enough, the Medicare tax can go up another 0.9%. We can skip through that. Okay. And this is the kind of income levels where it the Medicare tax jumps another 0.9%. Okay, so we did reporting compliance. That's why you're going to need ADP or paychecks, companies like that. If you have employees that are in other states, you're definitely going to need somebody to do this, and that's what they do best. So it's an outsourcing payroll service. Here's the independent contractor issue. That makes we're going to be able to wrap up most of the topics that I wanted to say very quickly in just a few minutes, and I'll take time for a little Q&A. Maryland payroll taxes, there are Maryland payroll taxes. You're going to have to follow the rules there. Again, an outsourced service will take care of this. It's unemployment insurance. This is all adding to that total rate that you pay in addition to the dollar salary that we talked about. You got compensation insurance, workers' comp insurance. You need to have that. These are all things you need to know. Don't forget them. And there is Maryland income tax withholding, just like there is federal income tax withholding. And you may have to withhold in other states. If you have employees that live in other states, again, the outsourced services will help you take care of that. One last thing on deductions before we roll through a few more slides. Depreciation deductions are quite interesting to take a look at with your accountant. If you're buying assets that have a life greater than 1 year, so it's just not a rent expense, these are subject to depreciation, but they can be very generous. The depreciation can be very generous, where perhaps you're writing it off, you're deducting the full cost in 1 year, the year you buy it. So it could be that under certain code sections, you can buy $100,000 worth of computers, let's call them laptops, and they can all be a deduction in 1 year, or you can spread the deduction out over several years if that makes more sense. All right, there are tax benefits for hiring disadvantaged people. These are just some tidbits. I'm going to run through a bunch of slides. It's just like put it in the back of your mind. If something strikes you, that would be something you would look up later. There's work opportunity tax credits for hiring individuals of special groups. Maryland has a list on their website of who they are. They're veterans, ex-felons. That may be tough that may be a tough pill to swallow to hire somebody like that, but I've had clients do it and they turn out to be great employees. So you get credits for hiring people like this. If you're in an empowerment zone, how will you know? You'll have to check with Maryland on their website. If you're in there, you'll get certain tax benefits for doing business there, for hiring people in the area. They're called empowerment zones. There's a Maryland disability tax credit. If you hire, I think that we said that on an earlier slide, if you hire someone with disabilities. Now we're into sales tax. I'll just very briefly, and then I'm going to stop, very briefly tell you that you got to be watching for Maryland sales tax. Even if you're not selling goods, but if you're selling services, they may be subject to the Maryland sales tax. And if you're operating across state lines, which most of you will be doing through the internet, you're going to have to check the rules in other states. Even if you don't have an office here, even if you don't have employees there, you got to check the rules to see if you have economic nexus in other states for sales tax purposes. Economic nexus means you're selling to the residents of other states. Maybe you're just selling services online. Maybe you're just selling, maybe selling goods online. But you got to check the rules of those other states to see whether you have to collect sales tax on those sales. That's called economic nexus. Pain in the neck. You probably would want to register your startup business in Maryland, at least under sales tax, because you may be able to buy things and not have to pay sales tax when you buy them, depending on the circumstances. But don't take that as a way to go out and buy without sales tax, because there is still a use tax. If you're the final consumer of a product, you still owe the sales tax, but it may be in the form of a use tax. It's the same rate as the sales tax. But you still want to register under sales tax in Maryland when you start up. We'll skip this slide because it's not really relevant. There is a state income tax, and there are state income taxes in states you may be doing business in, even if it's online, again, through that economic nexus. So you're going to want to have someone, most likely a CPA, check to see if your online status, your online exposure to other states, not only exposes you to potential sales tax rules in those other states, but if it potentially causes you to have to pay income tax to the other state where you have that economic nexus. By the way, welcome to my world. Okay, how to determine state nexus? Again, today it's not so simple. It used to be, do you have an employee there? Do you have physical presence? Now there's this economic concept. Are you doing business there? And that's the new 21st century way. All right, we can skip that. That's just how you do your state income tax calculation between all the states. Estimated taxes, if you are making money through a pass-through entity, you're going to want to watch the rules for estimated taxes, because taxes have to be paid as they're made, as they're earned. Remember, as an employee that's withheld, it's taken out of your salary. If you're making the money yourself, your own business, you may still have to do the same thing. You mimic it through estimated taxes. It's done quarterly, as you can see here. For 4 quarters, and you just monitor how much money you're making each quarter to determine what you need to pay in. 1099s, we talked about independent contractors. 1099s are forms. They're like W-2s, but they come in other varieties. These are requirements that most small businesses do have to file some of these to people who could be just your suppliers or your or service people. A company that services your computers may require you filling out a 1099 form on how much you pay them during the year. The good news is your payroll services, these outsourced places, can help you with that as well. So back to ADP and Paycheck, they can help you determine your requirements there. Just make sure you know you're supposed to do this. Don't rely on someone to tell you, put it in your head. Okay, and that's all I need to say. This goes without saying, you got to keep records, good books and records to substantiate what your deductions look like, what your income looks like, and that's just the tip of an iceberg, my friends.
Thank you so much. I know it's kind of hard to give a detailed overview in just 1 hour, but thank you so much. This has been extremely useful. I wanted to add that we will have a second session to part 2 to this lecture in October. So stay tuned. I'm going to make sure that everybody who was on this session will get an email from me with the link to sign up for session 2 in October.
Are there any other Q&As in the chat box, did you see?
Yes, there's one more question. What is the IRS audit rate for business?
Oh boy, that's a can of worms. Right now, it's probably less than 1%. It's pretty bad. But again, they have 3 years. They keep announcing, oh, we've got this program. We're going to go hit S corporations. We're going to go hit LLCs. I wouldn't worry about that, but don't play too many games. You can play loose a little bit, but don't go over the edge, if you know what I mean. Don't cross the line, the law, the line of the law. But it's pretty dismal at the moment.
Here's one more question just came in. When establishing an LLC, would you recommend getting help from a CPA?
I would think, after listening to myself the last hour, I would think the conclusion's got to be you're going to need a CPA. I don't know how you get through this without one. What's good for a business owner, a startup owner to know is what are the issues. You need to know the issues. You need to understand what should be done, what questions to ask. The second session we're going to do is even more in tune to STEM entrepreneurs, because we're going to do the research and development credit, and we'll look at certain things that apply to businesses that are in the tech world as well, science world, where there's additional credits, additional tax benefits that we didn't talk about today. So you just need to know what's available to make sure you ask the right questions. And without a CPA, I'm not sure how you do it. And I'm not saying this self-serving. If you go online to like Amazon or any online bookstore, Barnes and Noble, and peruse the index of all books on startup businesses and look in the index for accountants or CPAs, and I'm telling you, you're going to see every single person saying you need to get one, get a good one.
Yeah, very important. Dealing with the IRS is not fun.
I'm not going to sell the business of being an accountant to your viewers here, because they're already well established. But having had a career in tax, I can tell you it's been a joyride, because it's so exciting. Every day's different. Things are changing. The landscape is never the same, and it means the challenges are always there. It doesn't get boring. I've never been bored.
Absolutely. We have one more question, which is a very big topic. So maybe this is something that could be covered in another session. Would you offer information about starting a nonprofit organization?
That's a great question. And why it's a great question is because one of the concerns about people who are startup entrepreneurs is, I need to raise money to help my business. So who are you going to go to? Well, you go to family, you go to friends, you can go to the marketplace of angel investors and private equity funds, and depends on the nature of your business. But that's one of the key factors, is how you're going to run your business. You need capital. Go to the bank. The nonprofit actually is not off the charts as a choice of entity from the standpoint of, hey, if you're doing something green, if you're doing something that is like going to help the world, or even the local world that we live in, like the state of Maryland, it may be that being a nonprofit is a great way to raise that capital, because it's charitable. It's a deduction to the people giving it to you. It's a write-off to them on their individual return. It's a feel-good contribution, and you don't have to pay it back. So there are instances where it pays. Now, one thing, and I think we should think about, you and I should think about having a separate seminar on nonprofits. One thing about it, I have to let you know, is that the nonprofit idea means you're always going to be working for a nonprofit. You're never going to be the owner of it. You can't sell it and profit off of what you grow. So if you're doing something that's going to scale and be worth 10, 20, 30 million dollars to some big company, that's not going to go to your pocket. So that's, nonprofit, when you open a nonprofit, you are really giving that to the public as donating your services, your time. You'll get paid for it, perhaps, if there's money for a salary to you, but you can't profit off of it.
Right. You can pay yourself a salary out of it.
Absolutely. Yeah. A reasonable salary. You can pay yourself a reasonable salary. And the board of directors is going to help determine that. So you're going to need outside people, and your board can't be all your your immediate family members. It has to be made up of a cross section of the public. But they'll determine your salary, and and your length of contract and so forth.
Thank you. Yeah, maybe this could be another session sometime down the line. So
Yeah.
thank you so much. Thank you, Sam, and thank you to everyone who came and stayed to the end. This has been fantastic, very informative. This session will be posted on our Startup PMD YouTube channel, so feel free to watch it again there. And usually we repeat it about once a year. So if there are any new regulations or new information, it's always updated at least once a year. So thank you so much for doing this for us, Sam.
God bless everybody. Be well.
Thank you.
And send out my email address, because I'm part of the school. I'll be glad to respond to anybody who has questions.
Yes, thank you so much.
Okay.
Have a great day.
Thank you.